The moment you step off an international flight, your travel budget starts leaking value. The financial infrastructure is quietly taking a cut. If you swipe your standard domestic debit or credit card abroad, your bank applies a foreign currency markup. On average, that markup drains between 3 and 5% of your total transaction value. You spend $100, but your account is billed $105. Then there is dynamic currency conversion, or DCC. This happens when a foreign card terminal offers you the convenience of paying in your home currency. Accepting that offer subjects you to a heavily inflated exchange rate set by the local merchant's bank, stacking an invisible premium on top of your own bank's fees. To stop this automatic financial drain, the global banking industry offers a dedicated defensive tool, the prepaid Forex card. Instead of converting money at the exact moment of purchase, you lock in your funds beforehand. Protecting not 5% margin is the difference between staying strictly on budget and unknowingly funding international banking fees with your vacation savings. HDFC Bank's answer to those fees is the Regalia Forex Plus card. It is their premium prepaid solution, engineered specifically to bypass standard credit card penalties. The core marketing promise is straightforward. You load the card exclusively with US dollars, and you can spend it globally without paying any cross-currency markup fees. This matrix compares carrying cash, standard credit, and a Forex card across theft risk, conversion fees, and acceptance. The Forex card neutralizes the physical risk of cash and strips away the conversion fees of standard credit cards. But eliminating that specific exchange rate math introduces rigid operational costs. Acquiring it requires a joining fee, reloading it requires a fee, and ATM withdrawals trigger charges. The decision to get this card comes down to one question. Does the complete elimination of foreign exchange markups justify the upfront friction and strict fee structure of managing a prepaid account? To understand the cost-benefit, you have to look at the loading mechanism. No matter where you are traveling, London, Paris, or Tokyo, you can only load the Regalia Forex Plus card with US dollars. This flow map illustrates how the Visa network handles the back-end math. When you swipe the card in Europe or the UK, Visa automatically converts your US dollars into euros, British pounds, or Swiss francs. Because of its specific programming, you pay a 0% cross-currency markup. But the operational catch is the recurring penalty to keep it funded. Every time you transfer money, HDFC charges a flat reload fee of 75 rupees. Furthermore, the card generates absolute zero yield. You will not earn a single reward point or a fraction of cash back on any of your international spending. This means the card operates strictly as a defensive tool. It is built entirely to shield your existing money from fees, abandoning the wealth-building potential you would normally find on a premium travel credit card. Even in highly digitized economies, physical cash remains a mandatory requirement for public transit, local street markets, and tipping. You will eventually need an ATM. Using the Regalia Forex Plus at a foreign ATM is secure and automatically protects you from those dynamic currency conversion traps we mentioned earlier. This bar chart compares the penalty structure. Look at the total fees for making a single $500 cash withdrawal versus making 5 separate $100 withdrawals in a week. Because HDFC applies a fixed $4 penalty to every withdrawal, frequent ATM trips are mathematically punished, accumulating $20 in fees. If you carry this card, you must follow a strict operational rule. Cash must only be withdrawn in rare, maximum limit transactions to dilute the impact of that flat fee. Acquiring this tool requires an upfront barrier to entry, an issuance fee of 1,000 rupees plus GST. That fee primarily buys a comprehensive security net. The card includes a 5 lakh rupee cover against skimming and counterfeiting, alongside built-in travel insurance for lost check-in baggage and personal documents. HDFC also heavily advertises the card's complimentary airport lounge access. However, this perk has a severe geographic limitation. You are granted 1 lounge visit per quarter, and it is strictly limited to international terminals located physically within India. The 1,000 rupee upfront cost is essentially a premium paid for baseline travel insurance. The lounge access provides zero utility during your return flights or if you are stuck on a long layover in a foreign country. The application process is nearly friction-free, requiring only basic Know Your Customer documents, such as your valid passport, your travel visa, and PAN card. It entirely skips income proof requirements. Standard premium travel credit cards demand strict salary brackets and high credit score prerequisites before they will issue you a zero markup product. The trade-off is that your financial discipline goes unrecorded. Because this is a prepaid instrument, managing it perfectly does nothing to build your CIBIL score, the standard credit rating used by Indian banks. It functions as an egalitarian financial tool. Anyone with a valid flight ticket can acquire it, operating purely on simple cash-in, cash-out logic without borrowing money. We can now evaluate the card's trade-offs against your specific travel profile. This decision tree maps out exactly who should buy it. Segment A is the first-time traveler, or the student studying abroad, who relies primarily on dependent income or savings. The lack of income requirements makes this card immediately accessible. It provides an essential layer of security and stops the heavy markups their standard domestic debit cards would otherwise incur. Segment B is the multi-country backpacker, moving across several borders in a single trip. For them, geographic efficiency is paramount. They can load US dollars once and seamlessly swipe across Euro, Swiss franc, and yen zones without cross-currency penalties eating into their funds at every new border. If you lack a deep credit history, or you are navigating highly fragmented currency zones, the Regalia Forex Plus is the optimal financial shield. Segment C is the reward optimizer. This is the traveler who already qualifies for or currently holds premium travel credit cards. This line graph tracks the net value of both approaches. A premium credit card charges a 2% Forex fee, but offsets it with a 3.3% reward yield, putting you mathematically in the positive. The Forex Plus card flatlines entirely, zero markup, zero yield. If you are in Segment C, you should actively avoid the Regalia Forex Plus. The lost opportunity cost of generating high-value reward points outweighs the benefit of a 0% markup. The Regalia Forex Plus is an ironclad utility shield designed to prevent loss, not a lifestyle product designed to generate value. Choose it if you need guaranteed convenience and budget control over reward optimization.